Okay, let's unpack this. Today, we're diving deep into a document that, well, on the surface, might look like just another piece of government paperwork, honestly. But trust me, understanding it is an incredible shortcut to being really well informed about your finances, especially if you're a foreign individual earning income from the U.S. We're talking about Form W-8BEN. And this isn't just about ticking a box. It's really about unlocking potentially significant tax savings. It's about making sure you keep more of your hard-earned money.
That's absolutely right. International tax forms, they can often feel like trying to navigate this dense, confusing forest. But Form W-8BEN, it's one of those essential tools that once you sort of demystify it, simplifies so much for foreign individuals dealing with U.S. income. It's truly about making sure you're taxed accurately and, crucially, that you're not paying more tax than you legally owe, especially by leveraging things like tax treaties. And what's particularly interesting, I think, is how these forms aren't static, right? The IRS, they regularly update them to keep pace with new types of income, new transactions, even how we submit them. Like, the increasing use of electronic signatures, it shows they're always
All
evolving.
right, constantly changing. So let's start right at the beginning. What exactly is this Form W-8BEN? Its full official name is the Certificate of Foreign Status of Beneficial Owner for United States Tax Withholding and Reporting Individuals. That's a mouthful. But here's a really important distinction. It is not a tax return. You don't send this to the IRS to, like, calculate your taxes for the year.
No, definitely not.
Instead, think of it more like a declaration, a sworn statement maybe, that you make to the person or company that's paying you. It's your way of clearly stating, hey, I'm not a U.S. person for tax purposes, and here's the proof.
Precisely. It's establishing your status.
Now, why is this declaration so incredibly important for your wallet? Why should you care? Well, generally speaking, if you're a foreign person receiving certain types of income from U.S. sources, that income is subject to a flat 30% U.S. tax rate. Flat rate, 30%.
Yeah, and that can be a bit of a shock if you're not expecting it.
Definitely. And this isn't a tax you pay later, like when you file a return. It's typically withheld right at the source. So imagine your U.S. bank or maybe a company pitched you dividends from U.S. stocks, literally taking 30 cents out of every dollar before it even reaches your account. Yeah. And we're talking about various types of U.S. income here. Things like interest payments, those dividends we mentioned, rental income from U.S. properties, royalties from intellectual property, annuities, even certain payments for services performed in the U.S. And that 30% tax, it's applied to the gross amount of the payment before any deductions. So it can be quite substantial.
Absolutely. Gross withholding is key there.
And this right here, this is where your first and maybe most significant opportunity for, well, tax optimization for tax savings comes into play. By providing a properly completed Form W-8BEN, you achieve a few absolutely crucial things. First, you definitively establish that you are not a U.S. person. That changes how you're treated for tax purposes right off the bat.
Okay, step one.
Second, you declare that you are the beneficial owner of the income. What that really means is you're the one who actually owns the money and gets the economic benefit from that payment, not just, someone holding it for someone else.
Right, not an intermediary. You're the end recipient.
Exactly. And third, and this is the direct path to keeping more of your money, the real tax saving part, you can claim a reduced rate of, or even a full exemption from, that 30% withholding. How? Well, if you are a resident of a foreign country that has an income tax treaty with the United States, and you meet the specific conditions in that treaty, you can leverage those benefits.
That's the key, the treaty benefits.
This is your direct, clear route to potentially significant tax savings right from the start. Instead of that default 30%, the person paying you, the withholding agent, can then apply a much lower treaty rate. Maybe it's 15%, maybe 10%, sometimes even 0%, depending on the treaty and the type of income. Imagine turning a 30% tax bite into, say, 10% or nothing. That's real money staying in your pocket. Huge difference.
A massive difference, yeah.
But the W-8BEN's power, it goes beyond just avoiding that big 30% chunk, right? It's also vital in other situations to prevent something called backup withholding, or just to ensure proper information reporting by the payer.
Right, backup withholding is another thing entirely, usually around 24%, I believe.
Yeah, exactly. So, for example, if you're receiving proceeds from selling stock through a U.S. broker, or maybe interest from a U.S. bank deposit, or even certain gambling winnings, providing this form confirms your foreign status for those situations too. This helps make sure that those types of income aren't mistakenly hit with that backup withholding. It's all about ensuring the payer knows who you are from a tax perspective, so they apply the correct rules from day one.
It's about clarity for the payer.
The true power of this form, it really lies in how it enables the withholding agent, that's the entity paying you. A properly completed W-8BEN basically gives them the green light. They can confidently treat your payment as one going to a foreign person who actually owns the money. And that allows them, legally, to apply the correct and potentially much lower withholding rate based on your status or treaty claim.
It gives them the justification they need.
Exactly. Without this form, they're often legally obligated to play it safe and withhold at the full 30% foreign person rate, or maybe that 24% backup withholding rate. And that's a direct, immediate financial impact on your bottom line. Think of it like, I don't know, it's your gate pass to the express lane for tax benefits. Without it, you're stuck in the slow lane, potentially paying full price.
That's a good analogy. And to put this into a slightly larger context, Form W-8BEN is really a cornerstone for how the U.S. tax system handles income flowing out to foreign individuals. It serves multiple purposes, but primarily it helps the U.S. track and tax that income according to its laws. And it also plays a role in international agreements like FACSA, the Foreign Account Tax Compliance Act. You might have heard of that. It aims to improve tax compliance involving foreign financial assets. So this form, W-8BEN, it establishes your identity and your status for both these kinds of purposes, which allows for the correct application of all these complex tax rules.
Okay, so it's doing double duty in a way.
In a way, yes. And it's probably useful to quickly clarify two terms that are central here. First, a withholding agent. It sounds official, maybe like a tax professional, but it's simply any person or entity, U.S. or foreign, that controls, receives, or pays out U.S. source income that's subject to withholding.
So my bank could be one, or a company paying me dividends.
Exactly. Your U.S. bank, a brokerage firm, a company paying you royalties, even a U.S. partnership distributing income to you. They're the ones legally responsible for taking out the tax, for doing the withholding. Second, the beneficial owner. This is the individual who ultimately owns and benefits from the income. It's the person who, under U.S. tax rules, would include that payment in their own gross income. So, for example, if income is paid to an agent or a custodian acting on your behalf, they aren't the beneficial owner. You are the person they're holding it for.
Okay, the person who actually gets the money at the end of the day.
Pretty much. Similarly, if income goes to, say, a simple foreign trust, the trust itself often isn't the beneficial owner. The individual beneficiaries usually are. It's about who truly benefits.
Got it. That makes sense.
And what's really quite fascinating here is how the IRS continuously updates and refines these forms. It's not static. For instance, there's been relatively recent guidance relating to withholding when foreign individuals sell an interest in U.S. partnerships, especially publicly traded ones.
Yeah.
Your W-8BEN helps determine the right withholding amount in those specific scenarios. We've also seen the addition of dedicated lines on the form for foreign tax identifying numbers, FTINs, which reflects this increasing global exchange of tax information between countries.
Ah, yes. The FTIN. We'll get to that, I'm sure.
We will. And also the formal guidance on electronic signatures. That just makes it much easier and more efficient to submit these forms in our, digital world. These changes show that even standard tax forms are kind of living documents, constantly adapting to the complexities of the modern global economy.
Right. Keeping up with the times. Okay, so now that we understand what Form W-8BEN is and how it's really your key to maximizing tax efficiency, let's talk about who specifically needs to provide this form, and maybe even more critically, who absolutely should not use it. Because using the wrong form, well, that can create significant headaches, cause delays, and directly impact your ability to save on taxes.
Absolutely crucial distinction.
Primarily, you must provide Form W-8BEN to the withholding agent or payer if you are a non-resident alien individual who is the beneficial owner of income that's subject to U.S. tax withholding. That's the main group. This also applies if you're an account holder at a foreign financial institution, maybe like a bank outside the U.S., and you need to document yourself as a non-resident alien for their purposes, often related to FACO.
FFIs need this documentation.
And here's a common scenario. If you're the single owner of what's called a disregarded entity, like a single-member LLC that hasn't chosen to be taxed as a corporation, you, the individual owner, are considered the beneficial owner of any U.S. source income that entity receives. So you would submit Form W-8BEN with your information, not the LLC itself.
Right. The income flows through to the individual owner for tax purposes in that case.
Exactly. The form is also required in other specific situations just to establish your foreign status for proper reporting and withholding. For example, if you're a foreign individual receiving payments through certain online platforms for services or goods, the gig economy stuff that can trigger specific reporting requirements, or if you're involved in certain life insurance transactions where your foreign status needs to be confirmed for U.S. tax purposes. Basically, anytime your foreign individual status impacts how a payment is taxed or reported in the U.S., this form, W-8BEN, is typically what you'll need.
But, and this is a really crucial point where people can easily make a costly mistake, there are very important categories of people and entities who absolutely should not use Form W-8BEN. Trying to use it if you fall into one of these categories can lead to incorrect withholding, processing delays, all sorts of problems.
Okay, so who should steer clear?
Well, first, big one. If you are a foreign entity, like a foreign corporation, a foreign partnership, or even certain types of foreign trusts or estates, you should generally use Form W-8BEN-E instead. That's E for entity.
W-8BEN-E. Got it, not W-8BEN.
Correct. That's a very common mix-up that can definitely hold up payments. Even more importantly, perhaps, for individuals listening. If you are a U.S. citizen, it doesn't matter if you live outside the United States or if you are any other U.S. person, including a U.S. resident alien individual. You should not use Form W-8BEN.
Okay, so U.S. citizens, even expats and U.S. residents, no W-8BEN for them.
Absolutely not. For U.S. persons, the correct form to document your status to a payer is Form W-9, Request for Taxpayer Identification Number and Certification. Now, how do you know if you're a U.S. resident alien? The IRS basically has two main tests. There's the green card test, pretty straightforward. If you're a lawful permanent resident, you pass. Or there's the substantial presence test. This one looks at how many days you've actually been physically present in the U.S. over the current year and the 2 preceding years, using a specific formula.
The day counting test.
Exactly. If you meet either the green card test or the substantial presence test, you're generally considered a U.S. resident for tax purposes, and Form W-9 is the form you need to give to payers. And this distinction is vital because, remember, U.S. persons are generally taxed on their worldwide income, whereas non-resident aliens are typically only taxed by the U.S. on their U.S. source income. Using the wrong form can lead to incorrect tax treatment, potential penalties, just a mess.
Definitely want to avoid that. Are there other do-not-use scenarios?
Yes, a few other key ones. For example, if you're acting as a foreign intermediary, meaning you're receiving the income not for yourself but on behalf of others, maybe as an agent or a custodian, you typically use Form W-8IMY for intermediary. Also, if you're a non-resident alien individual claiming an exemption from withholding specifically for compensation related to personal services performed in the U.S., like independent contractor work done while physically in the U.S., you'd usually use a different form, maybe Form 8233 or sometimes Form W-4, depending on the situation.
Okay, so specialized forms for services income.
Right. And here's another big one. If you're receiving income that is effectively connected with the conduct of a U.S. trade or business, basically, income tied to an active business you're running in the U.S., you should generally use Form W-8ECI. ECI for effectively connected income.
W-8ECI for business income earned in the U.S.
Generally, yes. Now, there's an important nuance here. If this effectively connected income is allocated to you through a partnership, Form W-8BEN might still be used for certain specific partnership-related withholding purposes. It gets complicated. But the key thing is, if your circumstances change, say, income you initially certified on a W-8BEN later becomes effectively connected to a U.S. business, your W-8BEN becomes invalid for that specific income. You'd need to notify the payer and provide a W-8ECI instead. So the crucial takeaway here really is that understanding these distinctions upfront is absolutely key to avoiding delays, incorrect withholding, or even, serious compliance issues later on. Getting the form right from the start is a direct pathway to preventing unnecessary tax burdens and making sure you get those savings if you're eligible.
That is critical advice.
Yeah.
Okay, so once you've figured out that, yes, Form W-8BEN is the right form for you, where do you actually send it? That's another place people sometimes get confused.
Yeah, common question.
You never send Form W-8BEN directly to the IRS. Never. Instead, you always provide it to the withholding agent or the payer. That's the bank, the brokerage firm, the company, the platform, whoever's making the payment to you.
Right, the source of the income.
Exactly. And the key is to provide it before the income is actually paid or credited to your account. Be proactive. This proactive step allows them to apply the correct, potentially reduced withholding rate right from the very first payment. If you don't provide this form when they ask for it, or before the first payment, The withholding agent will likely have no choice but to withhold at that full 30% foreign person rate or the 24% backup withholding rate.
They have to protect themselves and follow the default rules if they don't have your certified status.
Makes sense. And a quick but really vital note about joint accounts. Let's say you own an income stream, like a dividend-paying stock, or maybe a bank account jointly with one or more other individuals. That income or that account will only be treated as foreign and thus eligible for the W-8BEN benefits, like treaty rates, if all of the owners provide their own valid forms, W-8BEN, or, if applicable, W-8BEN-E for any entity owners.
Everyone on the account needs to certify their foreign status.
Everyone. Because if the withholding agent or the financial institution receives a Form W-9 from any one of the joint owners, the entire payment or the entire account will generally be treated as made to a U.S. person, and the account treated as a U.S. account. And that means U.S. withholding and reporting rules will apply across the board, which could completely wipe out the tax savings opportunities for any foreign co-owners on that account.
Oof, yeah. That's a big trap for joint accounts. Communication and correct forms from everyone involved are essential there.
Absolutely. So clear communication, get those forms in from everyone. Okay, let's get into the practical side now. Actually filling out the Form W-8BEN, this is where you actively take control to protect your income and, importantly, unlock those valuable tax benefits we've been talking about. We'll go through it pretty much line by line, focusing on how each piece of information is critical for your tax situation and for maximizing your financial position, especially getting those lower tax rates.
Sounds good. Let's dive in.
All right, starting with Part 1, Identification of Beneficial Owner. This section is all about establishing who you are and confirming your foreign status. Line 1, Name of individual beneficial owner. Seems simple, right? Just your name. But there's that specific nuance we touched on earlier. If you're a foreign individual who is the single owner of a disregarded entity, that single-member LLC, for example, you complete this form using your name and your information as the individual owner.
Right. The entity is disregarded, so you look to the owner.
Exactly. If the account itself is technically in the name of the disregarded entity, you can just make a note of the entity's name for the pair, maybe down on line 7, reference number, so they can correctly link your individual W-8BEN form to that entity's account. This just ensures the IRS properly links the income to you, the individual, for tax purposes.
Good practical tip.
Line 2, Country of citizenship. This is generally the country that issued your passport. Now, if you hold dual citizenship, the instructions say you should enter the country where you are both a citizen and a resident for tax purposes at the time you're completing the form. If you're not a resident in any country where you hold citizenship, then use the country where you were most recently a resident. But here's that crucial reminder again. If you are a U.S. citizen, even if you also hold citizenship in another country and live abroad, you do not complete this form. You'd use Form W-9 instead.
Can't emphasize that enough. U.S. citizens use W-9.
Line 3, Permanent residence address. Okay, this is a really important line. This must be your actual residential address in the country where you genuinely claim to be a resident for that country's income tax purposes.
Yeah.
It's your true tax home. You absolutely cannot use a P.O. box here. You can't use an in-care-of-it address just for receiving mail. And you definitely can't use the address of a financial institution where you just happen to have an account.
Needs to be a real street address where you reside.
Exactly. And crucially, if you're planning to claim a reduced withholding rate under an income tax treaty in Part 2, which remember is a major part of your tax saving strategy, your residency for this line must align with how residency is defined under that specific treaty. Think of this as proving where your true financial life is centered. This address directly supports your claim of being a foreign person eligible for certain tax treatments, especially those treaty benefits.
It anchors your claim, essentially.
It's line 4. Mailing address. Only fill this out if it's different from your permanent residence address on line 3. Maybe you receive mail somewhere else. If they're the same, just leave line 4 blank. Simple enough.
Fetch it forward.
Line 5. U.S. Taxpayer Identification Number, TIN, if you have one. Okay, this is a big one. This refers to either a Social Security number, SSN, which you'd only have if you're authorized to work in the U.S. at some point, or an Individual Taxpayer Identification Number, ITIN, which is issued by the IRS to foreign individuals who need a U.S. tax ID but aren't eligible for an SSN. You apply for an ITIN using Form W-7, usually along with a tax return or an exception document. It can take some time to get, so plan ahead if you need one.
Yeah, applying for an IPN isn't instant.
Right. Now here's why this line is so crucial for your tax savings. A U.S. TIN, either an SSN or an ITIN, is often required to claim certain specific treaty benefits. Not always, but often. Unless you can provide a valid foreign tax identifying number, FTIN, on line 6A, which we'll get to in a second. A U.S. TIN is also generally required if you are a partner in a partnership that's conducting a trade or business in the U.S., because partners often have U.S. tax filing obligations related to that partnership income.
Mm-hmm. Especially relevant for partnerships.
And remember, an ITIN is purely for tax administration purposes. It doesn't grant you any immigration status or work authorization in the U.S. It's just a number for the IRS. So bottom line for tax savings. If you're aiming to significantly reduce U.S. tax withholding through a treaty, having either an ITIN on this line or a valid FTIN on the next line is often a necessary step.
It's becoming increasingly important, yes.
Line 6A, Foreign Tax Identifying Number, FTIN. Okay, here it is. This reflects that global push for tax transparency we mentioned. If you're providing this form to document yourself as an account holder at a U.S. office of a financial institution, like a U.S. bank or broker, and you're receiving U.S. source income that will be reported to the IRS on something like a Form 1042-S, you generally must provide the FTIN issued to you by your country of times residence, the country you listed back on line 3.
Right. This is often required now for FASIA compliance by the financial institutions.
Exactly. Now, there are specific exceptions. For instance, if you're a resident of a U.S. territory, or if your country simply doesn't issue TINs to its residents, or doesn't legally require you to have one. But here's the important implication for your tax planning and potential savings. In many situations, you can provide this FTIN instead of a U.S. TIN on line 5 when you're claiming treaty benefits. This can offer flexibility if getting an ITIN is difficult or unnecessary for you.
It provides an alternative pathway for treaty claims in some cases, which is helpful.
Definitely. Line 6B. Check if FTIN not legally required. So related to what we just said, if you are an account holder at a U.S. financial institution, but you are not legally required to obtain an FTIN from your country of residence, maybe your country just doesn't issue them, or you don't meet their criteria for getting one, you can check this box. This basically explains to the withholding agent why line 6A might be blank and helps prevent delays in processing your form.
Clarifies the situation for them.
Line 7, reference number. This line is optional. Both you and the withholding agent can use it. You might use it to put in an account number or maybe a policy number or any other identifying code that helps the withholding agent link this specific W-8BEN form to your specific account or the payment they're making to you. And like we mentioned earlier, if you're the single owner of a disregarded entity and you put your name on line 1, you could use line 7 to list the disregarded entity's name or its account number, just for clarity.
Useful for internal tracking on both sides.
Line 8, date of birth. This one's required specifically if you're providing this form to document yourself as an account holder with a U.S. financial institution or certain other U.S. payers. You need to provide your date of birth in the MMDDYYY format. This is mainly needed for those institutions to comply with specific international reporting requirements, like VAT-Key.
Right, part of the account holder identification rules.
Okay, so that's part 1, establishing who you are.
And if we sort of connect all those dots from part I, you can really see how lines 5 and 6, the TIN lines, are absolutely crucial gateways. They effectively link you to your tax identity, whether it's U.S. or foreign. And that connection directly dictates how much U.S. tax is withheld from your income. Accuracy in part I isn't just about filling in boxes correctly. It really creates the fundamental basis for your entire claim of foreign status, and by extension, your eligibility for any reduced withholding or treaty benefits. For example, as we noted, for foreign partners involved in certain partnership interest sales subject to Section 1446 withholding, having that U.S. TIN on line 5 is specifically required for the correct withholding calculation. Without this foundational information being accurate and complete, the withholding agent simply cannot process your claim for a lower tax rate. They'll likely have to default to the highest applicable rate, meaning you miss out on potential savings right away. So yeah, take your time, be precise with these details in part 1.
Excellent point. Accuracy is key there. Okay, now let's transition to what is arguably the most impactful part for maximizing your financial position, especially regarding those tax savings part 2. Claim of tax treaty benefits. This is where you formally declare your eligibility for a reduced rate of U.S. tax or maybe even a complete exemption based on an income tax treaty between your country of residence and the United States. This is often the biggest win for individuals using this form.
This is where the magic happens, so to speak, for tax savings.
Exactly. Line 9. Country of residence for tax treaty purposes. This is where you explicitly identify the country where you claim to be a resident for the purposes of that income tax treaty. To claim benefits here, you must genuinely be a resident, as defined by that specific treaty, of a country with which the United States has an active income tax treaty. The good news is that the IRS website has a wealth of information on all U.S. tax treaties, including lists of countries and often the treaties themselves, so you can check if your country has one and what it covers. It's really important that your residency for treaty purposes is consistent with how the treaty defines it, which often involves more than just living there. It relates to your overall tax home.
Right. Treaty residency can be complex, but this line is your declaration.
And now for line 10, special conditions for claiming treaty benefits. Okay, here's where it gets really interesting for maximizing your tax savings in specific situations. This line is used only when the particular treaty benefit you're claiming requires you to meet certain conditions beyond just being a resident of the treaty country. These are scenarios not covered by the general certifications you make elsewhere on the form. You typically don't need to fill this line out for standard interest or dividend payments claiming a basic treaty rate, unless maybe those dividends qualify for a special lower rate based on your level of ownership.
So this is for more specific, complex treaty claims.
Exactly. Let's look at some key examples of when you absolutely must complete line 10 to secure those specific tax benefits. First, if you're claiming treaty benefits on royalties, like payments for patents, copyrights, etc., you'll often need to use line 10 if the treaty provides different withholding rates for different types of royalties. Example, industrial versus artistic. You need to specify the type of royalty and cite the relevant article and rate in the treaty that supports your claim for that specific reduced rate.
Okay, so differentiating royalty types.
Second, and this is a really significant tax saving point for many international students and researchers. Foreign students and researchers receiving non-compensatory scholarship or fellowship income from U.S. sources. They can use Form W-8BEN to claim treaty benefits to potentially reduce or even completely eliminate U.S. tax on that income. A W-8BEN isn't even required for this type of income unless you are claiming a treaty benefit.
Very important for students.
Absolutely. And here's a key nuance that saves people money. Most treaties that offer an exemption for scholarship or fellowship income require that the recipient was a resident of the other treaty country at the time of, or immediately prior to, their entry into the United States to study or conduct research. So think about this. Even if the student or researcher now lives in the U.S. temporarily and might even put a U.S. address on line 3, if appropriate, they can still claim the treaty exemption on line 10 if they were a resident of that treaty country just before they came to the U.S., and they meet all the other conditions of the treaty article, like time limits, purpose of visit, etc. They would still identify their original treaty country on line 9. This is a very direct way to significantly reduce or even eliminate U.S. tax on educational grants, which can be a huge financial relief and a major tax saving.
That's a fantastic point. The timing of residency matters hugely there.
Definitely. Third example for line 10. Claims related to business profits or gains not attributable to a permanent establishment. Okay, this sounds complicated, but I'll try to simplify. A permanent establishment, or PE, is essentially a fixed place of business in the U.S. Think an office, a factory, a branch, maybe even certain types of long-term projects. Yeah. If your business profits or gains, excluding those from selling U.S. real estate, which have separate rules, are not linked to such a fixed place of business in the U.S., you might be able to claim treaty benefits here to reduce or eliminate U.S. tax on those profits. You would use line 10 to state that your business profits or gains are not attributable to a PE in the U.S. and cite the relevant treaty article that provides the exemption. For instance, if you're a foreign partner who sells an interest in a U.S. partnership that conducts business here, you might be able to use line 10 to claim treaty benefits to reduce withholding on those gains, arguing they're not connected to a U.S. PE under the terms of the treaty. If your claim relates to an interest in a publicly traded partnership, PTP, you must also specifically name that PTP on line 10. This can lead to a significant reduction or even complete exemption from U.S. tax on certain business-related gains, another big area for tax optimization.
Understanding the PE concept is key there, but potentially very valuable.
And finally, a very specific but potentially powerful tax optimization mechanism, mostly relevant for individuals from certain countries like the UK remittance claims. Some U.S. income tax treaties, particularly with countries that have a tax system based on remittance, meaning you're only taxed there on foreign income if you bring it into the country, only allow U.S. treaty benefits on income that is actually remitted to or received in that treaty country. If you are taxed on a remittance basis in the treaty country you identified on line 9, you must complete line 10. You'd state that you're taxed on a remittance basis, specify the amount of income associated with this specific W-8BEN form that was actually remitted to and is taxable in that home country, and provide the relevant treaty article number. This essentially ensures you might still be taxed in the U.S. on the portion of the income that isn't remitted and thus isn't taxed back home, effectively preventing potential double non-taxation while still potentially getting benefits on the remitted part. It's a way to fine-tune the treaty benefit based on actual remittance.
Very specific, but crucial if it applies to your home country's tax system. And building on all these treaty benefits discussed in Part 2, it's really important to understand something called the saving clause that's present in almost all U.S. tax treaties. Generally, what this clause says is that both the U.S. and the other treaty country retain the right to tax their own citizens and residents as if the treaty didn't exist.
So the treaty doesn't let a country's own residents avoid its regular taxes.
Broadly speaking, yes. So once you become a U.S. resident for tax purposes under the green card or substantial presence tests, the treaty benefits usually no longer apply to you for U.S. tax purposes. You typically switch from providing Form W-8BEN to providing Form W-9. However, and this is important, there are often specific exceptions listed within the saving clause itself. These exceptions allow certain treaty benefits to continue even after you become a U.S. resident. These exceptions often apply to specific articles, frequently including those related to pensions, Social Security, and importantly, the benefits for students, trainees, and researchers we just discussed.
Oh, interesting. So even as a U.S. resident, a student might still get treaty benefits.
Potentially, yes, if their treaty has that specific exception in the saving clause. For instance, the U.S.-China Income Tax Treaty has a provision that allows an exemption for scholarship income received by a Chinese student who's temporarily in the U.S. The treaty specifies that this benefit continues even if that student stays long enough to become a U.S. resident alien under the substantial presence test. In such a unique case, even though they are now a U.S. resident, they would use Form W-9 because they are a U.S. resident, but they could still potentially attach a statement citing the specific treaty article to claim the ongoing exemption for that scholarship income. It's complex.
Oh, okay. That's a really nuanced point.
It is, and it highlights a really important question for anyone dealing with international tax. Understanding these nuanced treaty clauses, like the saving clause and its exceptions, is absolutely vital for long-term tax planning, especially if your residency status might change over time. It directly impacts which form you use, W-8BEN or W-9, and whether your tax benefits continue. So, reinforcing the main point here, accurate and detailed completion of Part 2 is your direct pathway to enjoying those reduced U.S. tax rates or outright exemptions due to tax treaties. It is truly the core of maximizing your financial position, the real S, or tax saving, when dealing with U.S. source income as a foreign individual. Overlooking a detail here, like not checking a box on line 10 when needed, could mean missing out on substantial financial advantages.
Absolutely. Yeah. Getting Part 2 right is where the real savings potential lies. Okay, we've covered why Form W-8BEN is so important, who needs it, who doesn't, and how to fill out the crucial Parts 1 and 2 to claim your foreign status and treaty benefits. Now, let's look at the final critical step, Part 3, certification, and then, maybe most importantly, how to ensure your tax savings continue over time. Because this isn't a one-and-done kind of form, is it?
Definitely not. It requires ongoing attention.
Right. So Part 3, certification. This is where you sign and date the form. It must be signed by you, the beneficial owner of the income. Or it can be signed by someone legally authorized to act on your behalf, an agent acting under a duly executed power of attorney, for example. If an agent is signing, the form typically needs to be accompanied by a copy of that power of attorney document, or an explanation of why it's not required.
Proof of authority is needed for agents.
Yes. And this signature isn't just a formality. By signing, you are certifying, under penalties of perjury, that all the information you've provided on the form is true, accurate, and complete to the best of your knowledge and belief. You're also certifying that you are the beneficial owner, or authorized to sign for them, that you are a foreign person, and if you claim treaty benefits in Part 2, that you meet the residency requirements for that. Both you and any agent signing can face liabilities if the form contains false information.
It's a serious declaration.
It is. Now, a quick note on convenience. Many withholding agents may allow you to provide this form with an electronic signature, which is great. However, for it to be valid, that electronic signature needs to be, well, robust enough. It needs to clearly indicate that it was genuinely signed by you, the authorized person. This might involve things like a time and date stamp, identity verification, or other security features. Simply typing your name into a signature line on a PDF usually won't cut it. The withholding agent might also ask for additional documentation to support that the electronic signature is authentic.
Yeah, there are specific IRS rules around valid electronic signatures for these forms.
Right. Next, let's talk about the expiration of Form W-8BEN. How long is it good for? Generally, a properly completed Form W-8BEN remains valid for a period starting on the date you sign it and ending on the last day of the third full calendar year that follows the year of signing. So, for example, if you signed your form on, say, September 30, 2024, it would generally remain valid through December 31st, 2027. This means you can't just fill it out once when you open an account and forget about it forever. It has a limited lifespan. There are some very specific narrow conditions where it might remain valid indefinitely, but those usually relate to specific regulatory purposes and don't apply to most individuals claiming treaty benefits. This regular expiration date is a really critical point for maintaining your tax benefits without interruption.
You need to track that expiration date and be ready to submit a new one.
Exactly. And this leads us right into perhaps the most crucial point for continued tax savings, the concept of a change in circumstances. This is precisely why staying updated saves you money. The rule is, if any information on the Form W-8BEN you've submitted becomes incorrect or changes after you signed it, you are legally required to notify the withholding agent, payer, or financial institution within 30 days of that change.
30 days, that's the window.
30 days. And you must file a new Form W-8BEN, or perhaps a different form like a W-9 or W-8ECI if your status change requires it. This isn't optional. It's absolutely essential to maintain your correct withholding status, prevent potential overwithholding later, and avoid potential compliance issues down the line. It keeps your tax savings flowing correctly.
Proactive notification is key.
So what counts as a key change in circumstances that triggers this 30-day notification requirement? Well, if you used Form W-8BEN to certify that you are a foreign person, then moving and taking up residence at a U.S. address is definitely a major change in circumstances. Generally, moving from one foreign country to another foreign country doesn't invalidate the form for establishing foreign status itself. However, if you are claiming treaty benefits using Form W-8BEN based on residency in country A, then you move to country B for the U.S., that move is a significant change in circumstances relevant to your treaty claim. You absolutely must notify your withholding agent within 30 days of that move.
Because your treaty eligibility might change or cease entirely.
Precisely. This is absolutely critical for continuing to receive the correct treaty benefits and thus securing your ongoing tax advantages. If you move outside the treaty country, you might lose those benefits. Even more significantly, if you become a U.S. citizen or a U.S. resident alien by getting a green card or meeting the substantial presence test, after you submit Form W-8BEN, your entire U.S. tax situation changes fundamentally. You are no longer subject to the 30% withholding rate as a foreign person under those rules. You must notify the withholding agent or financial institution within 30 days of becoming a U.S. citizen or resident alien. And in this situation, you will then be required to provide them with a Form W-9 because you are now considered a U.S. person for tax purposes.
Right, W-8BEN becomes invalid, W-9 becomes necessary.
Exactly. Remember that substantial presence test we discussed earlier, the day counting? If you meet that test during a calendar year, thereby becoming a U.S. resident for tax purposes, students will have that same 30-day window from the point you meet the test to notify the payer and provide a Form W-9. Failing to update your form promptly could mean the withholding agent continues to withhold tax at the foreign person rate, like 30% or a treaty rate, even though you might now be subject to different U.S. tax rules as a resident, possibly even owing less U.S. tax overall depending on your situation. It could lead to unnecessary tax being withheld that you then have to claim back, or potentially a much more complex tax reconciliation process when you file your U.S. resident tax return. It's truly about staying ahead of your tax obligations and keeping things clean.
So what does this all mean for you, the listener, in practical terms?
Well, it boils down to this. Maintaining accurate documentation, like your W-8BEN, isn't just about ticking boxes for IRS compliance. It's really about continuously securing the tax benefits, the tax savings that you're entitled to. A lapsed form because it expired, or one that's out of date because you moved or your residency status changed. That can easily lead to the withholding agent reverting to those higher default withholding rates, the 30% rate, or maybe the 24% backup withholding rate.
Right, you could suddenly see a much bigger chunk taken out of your payments. Exactly. Imagine you moved from a country with a very favorable tax treaty, say 0% on interest, to a country without a treaty. If your W-8BEN isn't updated to reflect that move, your previous claim for that 0% rate becomes invalid. Now, without an updated form, one of two things might happen. The payer might mistakenly continue to withhold at the old, incorrect lower rate, which could lead to compliance complications for you later. Or, more likely, if they become aware of the change or the form expires, they might revert to the full 30% withholding because they lack valid documentation for anything lower. That essentially costs you money immediately, money that you'd then have to try and reclaim later by filing a U.S. non-resident tax return, Form 1040 NR, which is far more complex and time-consuming than simply providing the correct updated form upfront.
Much better to keep it current.
Much better. And this proactive approach, it also applies to scenarios beyond just passive income like dividends or interest. For instance, when it comes to proceeds from broker transactions like selling stocks or certain barter exchange transactions, Form W-8BEN is how you, as a foreign individual, certify your status as an exempt foreign person. This status generally helps you avoid backup withholding on those types of payments. So this means that a properly maintained W-8BEN can prevent unnecessary withholding across a pretty broad range of your financial interactions in the U.S., directly impacting your overall financial efficiency. So this really brings up an important question for all of us dealing with international finances. How often should you proactively review your tax situation in the forms you have on file, like W-8BEN, even if you don't think there's been a major change in
That's
circumstances?
a good question, like an annual financial checkup.
Exactly. Perhaps a simple annual check-in, maybe around tax time or when you review your investments, just to confirm your address, residency, and treaty eligibility haven't changed and that your form hasn't expired. That seems like a very wise practice to ensure you're continuously getting the best tax treatment you're entitled to.
Great advice. Okay, so let's wrap this up. What does this all mean for you, our listener? Form W-8BN, while yes, it might initially appear to be just another one of those dry, bureaucratic forms, is actually your essential shield. It's a protection against excessive U.S. tax withholding if you're a foreign individual. It is absolutely your key to unlocking valuable U.S. income tax treaty benefits, providing those crucial opportunities to optimize your tax situation, to save on taxes, and keep more of your own income. And, as we've just discussed, it's a document that requires ongoing attention and updates to ensure your continued financial well-being and uninterrupted tax savings. Understanding this form truly is a powerful shortcut to being well-informed and can lead directly to significant financial advantages in your pocket.
Absolutely. And perhaps a final thought to consider. As our global economy becomes ever more interconnected, understanding how your foreign status impacts your U.S. tax obligations really isn't just for the big international investors or large business owners anymore. Even seemingly small income streams, maybe dividends from just a handful of U.S. stocks you own, or perhaps payments you receive for remote freelance work from a U.S. client, all of these can be significantly affected by whether or not you've provided this Form W-8BN correctly and, crucially, kept it updated. So the question to ponder is, how might this deeper understanding of forms like W-8BN empower you to think differently about your entire international financial footprint? And what might be your very next concrete step in proactively managing your global tax identity to ensure you're always optimizing your tax situation and consistently securing those valuable tax benefits you're entitled to?
That's a powerful question indeed, something definitely worth thinking about. Thank you for joining us on this deep dive into the world of Form W-8BN. We really hope this conversation has helped demystify a crucial and often confusing aspect of international tax for you, putting you firmly in control of your U.S. tax withholding situation.